Hi, I'm Michael Gable, Managing Director at Fairmont Equities. In terms of the share market, it has been a very challenging year, one of the toughest that we've seen for a very long period of time. But despite this, we have had a number of good opportunities as identified in our weekly research report, The Dynamic Investor. So as we head to the end of the year, I thought it's worthwhile to cover off on a few, important topics and have a look at what we expect will happen next year and whether you try to take advantage of these opportunities through the Dynamic Investor report or whether you're looking to become a portfolio client with Fairmont Equities. I think now's the time to really get set up and really get yourself sorted for what's coming up next year, which can be a very good year. So in terms of what I want to look at, we'll cover off on inflation, bond yields. I'll talk about the latest US ISM PMI. We'll look at gold, oil, uranium, iron ore and copper, lithium, and then I'll just quickly talk about the broader market and what I expect for next year. So let's get stuck into it. So all the advice here, of course, is general only. So let's have a look at inflation. Enemy number one, basically it's on the way down. The trend continues to head in the right direction, and it is actually falling faster than expected. So, perhaps it was transitory after all. Look, here are the recent numbers. So in Europe, headline inflation, most recent numbers came in at 2.4% for the year, with core CPI at 3.6%. Again, all of these were lower than expected, and they are still falling, as we could see. Australian CPI, so monthly CPI, was expected most recently to be 5.2% for October, having risen to 5.6% in September. So the market expected 5.2, it came in at 4.9. So if the monthly CPI increases continue to average 0.3% in November and December, which is basically the average of the past 3 months, then year-on-year inflation will actually fall to 3% by the end of December. That's because last year we had a 0.9% month-on-month in November and a 1.5% month in December. So they drop out of your calculations and you actually end up with an inflation number that's basically right at the top of the RBA's target. So US CPI, again, only something we saw come in a couple of days ago. Annual inflation at the end of November, 3.1%. So down from the 3.2% the prior month. If you look at core inflation, it's unchanged at 4%. So a little bit above what the the Federal Reserve is targeting, but clearly it's on the way down. So let's have a look at US bond yields. So rising bond yields, of course, is what's caused a lot of havoc with the market. But I've spoken before about that when things go up in straight lines, they also come down in straight lines. So there's never been a sideways path or a higher for longer when it comes to bond yields, as the media would like to have you believe. If we have a look here at the US 2-year notes, they're down massively from their recent peak, as basically rate cuts for next year are looking more and more likely as the days go by. When we have a look at the Australian 3-year, which is a bit of a proxy for where our interest rates will be, they're now lower than the cash rate and falling. So weaker than expected CPI and GDP in terms of the recent numbers that have come through have pretty much flipped the expectations of a local rate rise in 2024 to expectations of a rate cut. Now, this is the US ISM PMI. So we've noted before that the ISM is the more reliable PMI for gauging the strength of the US economy. Basically, the services PMI was the most recent one that came out. It increased to a 52.7 in November, which was up from a 51.8 in October. So that beat forecasts of a 52. So remember, a reading above 50 indicates expansion. So that is, the data is not indicating a recession is on the way. And as we could see on this chart, the PMI is troughing. So it proves what we've been saying for months now. And this is basically a troughing, a bottoming out in the global economy. It'll start heading higher again. And this is when you get the biggest moves in the share market. So it's not when the PMI is at its highest, it's actually when it's low and starting to head up again. So with a falling CPI, you could suggest that the US economy is in a bit of a sweet spot here. So there's no recession, it's not running too hot. Look, we can try to make ourselves sound smarter and say the market's wrong and there's no such thing as a soft landing or a no landing given everything that's happened. But look, if we're just here to analyse the data and try to make money from it, this is what we're seeing. So there's no point trying to be smart for the sake of it. It really does look like things will work out after all. So gold, interest rates and gold have traditionally moved in opposite directions. I mean, over the past few years, this relationship has broken down slightly with interest rates heading higher and gold prices holding up. So the difference this time is central bank buying. So last year, central banks accumulated 1,136 tonnes of gold, which is a record. Year to date, central bank gold purchases are up 14% compared to last year, with China being the most significant buyer. So why are the central banks buying? Well, countries such as China and Brazil are already starting to sell goods to each other as a way to replace the US dollar. The US dollar is unlikely to be replaced as the global currency, but it won't stop countries from trying to diminish its importance. So, to do this, they need to settle their current account imbalances, that is, using gold. So if gold can hold up in these higher rates because of central bank buying, then what can it do when rates fall and central banks continue to purchase? And as we could see on this gold chart, it's knocking on the door of an upside break, and it looks like we're about to get that really big move. It's also useful to compare the price of gold to the money supply. So this chart shows the relationship between the size of the Fed's balance sheet and the US Treasury's gold holdings. So based on this, gold is more undervalued today than compared to the late 60s or 90s, which were the last times we saw really big increases in the price of gold. So even though gold is up more than 7 times in the past 23 years, the Federal Reserve's balance sheet has grown even faster, as we all know. So gold, it's at an all-time high and still undervalued. Well, yeah, that's clearly a possibility. So with the gold chart now looking to break through this long-term resistance and rates clearly on the way down next year, I wouldn't be too worried about the day-to-day movements. Have a look at a monthly chart, not a daily chart. Again, falling interest rates, central bank buying, over a decade of excess money printing can mean only one thing for the next few years, and that's upwards pressure on the price of gold. So oil, well, as we could see, sort of going back 15 years, it's back to the sort of average price. I expect it to stabilise here and then recover again. Energy stocks are still very much under-owned by investors. They account for less than 5% of the S&P 500, which is below the historical average of 14%. The outlook by the International Energy Agency, the IEA, is particularly gloomy. Between now and 2040, they project global energy demand to fall by 3%. And this is despite real GDP capital growing by 40%. So by 2040, we'll experience rapid growth in emerging markets. Now, when an economy is very poor, it consumes little energy, but as it reaches middle income, the energy demands grow materially. So, look, the IEA has a history of being pessimistic in its demand forecasts. If we ignore the COVID year in 2020, they basically underestimated oil demand in 12 out of the last 14 years by an average of 820,000 barrels per day. So global oil markets are already in a structural deficit. Crude demand exceeded production in 2021 because of the massive releases recently from the US strategic reserves, basically driving those levels down to a 40-year low. It's essentially masked this deficit. So we've seen the US stop releasing from its reserves in June, and now it's starting to replenish it. So when markets realise the economy's holding up, oil and gas demand is not in free fall, and supplies are low, the record low investment levels in oil companies, I think, will be a thing of the past. So, for example, we've seen prime Permian acreage in the US that could be bought for $5,000 per net royalty acre a few years ago, now fetching over $25,000. Exxon has announced it will purchase Pioneer Natural Resources, and Chevron will buy Hess, basically totaling transactions of $120 billion US. And locally, we're now seeing Woodside and Santos looking to merge and create an 80 billion Aussie dollar company. So the IEA's projections of lower demand are basically based on the assumption of improved efficiency, but never has improved efficiency reduced demand. In 1865, an English economist, William Jevons, noticed that as steam engines improved efficiency, it led to greater demand for coal, not less. So the Jevons paradox concludes that improved efficiency leads to accelerated consumption. So let's have a think about this. Over the past few decades, as cars become more efficient, they've not become smaller and lighter. As it becomes more efficient to cool or heat your home, houses have not become smaller. As it becomes more efficient to fly a plane, we haven't travelled less. So in other words, as energy becomes more efficient, we don't just use less of it, we just consume more of it. So talking about oil naturally leads on to talk about uranium. This year there have been notable wind and solar projects which have been cancelled or delayed due to rising costs. It takes a lot of resources to get a renewable energy project up and running. When money and energy were cheap, there was progress being made, but the numbers just don't stack up anymore with higher interest rates and commodity costs. This is why governments are turning to nuclear power now to fill the gap. Looking back over the past 30 years, the fall of the Soviet Union and agreements between Presidents Bush and Yeltsin in the early 90s saw uranium from old Russian warheads hit the market, and there was excess supply. Producers adjusted, supply fell away, became low, and then of course because of a lack of supply, the price of uranium took off in the mid-2000s, and we could see that on this chart. So obviously this is the classic sort of merry-go-round that we have become familiar with commodities supply and demand. During this time, the share price of Paladin soared from 5 cents to $9. But as usual, supply caught up after 5 years, prices collapsed. And then, of course, in 2011, the Fukushima disaster led to some closure of plants. Excess inventory from Fukushima was sold into the market. Excess supply meets low demand, and the uranium price collapsed again. It does appear as though these stockpiles have been worked through. So for the first time, uranium is in a structural deficit, and this will again take years to correct. The Sprott Physical Uranium Trust, which buys and sells physical uranium, has only been able to source small amounts in recent months, leaving it with about $60 million of cash on its balance sheet. That is, a physical-backed trust can't find enough physical to buy. So it'd be like a physical-backed gold ETF not being able to buy any more gold and just having to sit on the cash. So as more and more countries are announcing movements back into nuclear energy to meet their zero emission targets, and with almost no uranium around, we could see quite a move in uranium prices for years before supply finally catches up. Iron ore. Well, the price of iron ore has surprised all the analysts this year. We have noticed they've started to slowly move up their very low targets in the iron ore miners, but they're still sceptical. Once they become bullish, that will add more fuel to the big miners to head higher. Let's look at Fortescue. We've been bullish Fortescue shares all year, noting that a break above $23 will lead to levels into the high 20s. That's now happening. Start of the year, the analysts had targets closer to $15, now they're closer to $18. But in that time, Fortescue's moved from an average of $21 now to levels of 27. So imagine when they all start getting bullish and start jumping on the bandwagon. Recent comments by the Vale CEO indicate that the market will be very tight for a while yet. Look, Chinese PMIs have looked weak, but clearly they're numbers that you need to take with a pinch of salt. Or, to be more honest, you can't really trust the PMI numbers out of China. So we need to look at other things. there is stimulus in China. It's starting to work behind the scenes. I mean, how else do you account for a 16% spike in the iron ore price just in the past 6 weeks? So it'll only be a matter of time until the market realises that China's recovering. You know, we did think this would start earlier in 2023, and it has taken longer than we thought, but I think it's now starting to happen. And we can also see this bottoming of the Chinese economy through the consumption of copper. So copper is known as a bellwether for economic growth. For the first 8 months of 2023, year-on-year copper demand is up 11%, and most of that is coming from China. Chinese demand is up 12% year-on-year for the first 9 months of the year. Indian demand is now up 36%. So, look, on a day of covers basis, inventories are sitting at a very low 3 days, and historically that leads to near-term price spikes. Lithium, obviously a very popular topic. As we know, lithium carbonate and spodumene prices have collapsed about 80% this year, but they're now breaching the top of the cost curve. So just like 10 years ago with iron ore, when Fortescue was back at $2 and on its knees, investors in lithium are also wondering, well, when are these Chinese high-cost, low-quality producers going to curtail production because, you know, they're losing money? Past few weeks, we've seen the pace of selling pick up, and even the bearish analysts have turned even more bearish. And I mean, my recent comments to clients and, you know, in the media as well was that, you know, that could be a sign of capitulation in the share price, basically people giving up. So the headlines have suggested that demand is lower than expected, and that seems to make sense with what we've seen this year with China's apparent recovery. But as highlighted earlier, improving PMIs out of the US and Chinese demand for iron ore and copper suggests that we're pretty much, you know, at or near that inflection point where demand's really going to pick up again. So, look, if you closely study lithium supply, you know, well, those that do have suggested there hasn't really been a surge in supply in the last year. There have been a number of new projects being announced, which gives the impression of high supply. But as we could see, there's been quite a bit of M&A activity in the space. That suggests that those close to the ground are seeing the need to add to their exposures now before interest returns in the sector. And just in the past few days, we've seen some massive rebounds in lithium stocks on big volumes, which again adds more weight to my idea that recent weakness was just capitulation, and now we're seeing the lows, the short covering and the recovery. So look, in terms of the share market and looking out to next year, you know, in the short term, the market's starting to power ahead now. We've got, you know, lower CPI, we've got lower yields. All these are good for the market. They'll help interest rate sensitive stocks, and improving economic activity in the lower yields leads to a lower US dollar, which is good for resource stocks. So if we have a look at sort of what's happened this year or the last 2 years, it has been particularly frustrating, especially if you're watching the day-by-day movements. But when you zoom out and look at the bigger picture, I mean, I think the outlook becomes a bit more exciting. I mean, we've essentially been in a bear market for 2 years. So, look, maybe not by definition, depending on how you want to describe the bear market, you know, certain percentage down and so on. But essentially 2 markets of a year that hasn't trended. It hasn't gone to new highs across most sectors. So, you know, when you have a look at markets over time, you'll notice that bear markets, they may go on for 2 years, but they don't extend into the third. Normally by then, you know, markets start trending normally again, because whatever caused that original problem with the market, it starts to get unwound and we return back to normality. So, yeah, even just looking at this 30-year chart of the ASX 200, we can see there's a number of occasions where, you know, there's been a consolidation for a year or 2 years max before it leads to the next rally. So I'm really looking forward to what lies ahead in 2024. When you have a look at this weekly chart of the market, and I've put this chart up a few times throughout the year and made some pretty bullish calls. I'll put it up again. So essentially the way the market's traded since 2021, very choppy day by day, but big sideways movement, almost like an inverse head and shoulders. Very clear resistance line near 7,600. So just like with, say, the Fortescue chart, where we identified that major level of resistance and you'll get a massive move when you get through it, that's basically a similar situation with our market. Very big resistance at 7,600. Once it cracks that, you'd be looking at obviously a market trying to head well above 8,000. So again, really looking forward to what lies ahead in 2024. I'm seeing a lot of the uncertainty from this year around interest rates, inflation, etc., really start to give way. So I think we're going to get some pretty good moves next year, reliable moves, especially in these sectors that I've just mentioned. And we have to remember the first year of recovery is normally the strongest. So that's why I think now's the time to really get stuck into making the most of it from here. All right, so what can we do now? Well, there's two options. Get the research, set yourself up for 2024. So, if you're on the website, sign up to the Dynamic Investor, or if you're not, go to fairmontequities.com and sign up to the Dynamic Investor. We've identified some great trades this year, whether it's Fortescue with some of the gold stocks, the uranium stocks. But I am expecting that 2024 will be the big year, and I think there'll be many more opportunities. Second option, of course, if you want me to help you manage the share portfolio, just give me a call. We can start off with a portfolio review, and we can take it from there.